we look at some of the data we got yesterday, we touched on it in the top 3 things. Got the durable goods report for May yesterday. Most of the headlines surrounding the release were, negative sequential, worse than 18 months, month over month. But if we model things year over year, we're rate of change centric. If you follow the show, durable goods actually up accelerating to 2.7% year over year, with the 2-year comps accelerating again for a third month. So, look, you can't have negative sequentials for 12 straight months and still have a positive year over year comp. But the negativity surrounding the headlines yesterday was a little bit misleading, mischaracterizing. So in that first chart that we just showed there, that's the durable goods ex defense and aircraft. So if you go inside the report and you kind of strip out this stuff, if you strip out defense, you strip out ex defense and aircraft, that gives you your closest proxy on demand from actual household demands, the type of goods that households would be demanding. That was flat sequentially, but year-over-year growth accelerated to 5.3% year-over-year, so a 33-month high on that metric. So a little bit different than the negative sequentials being reported by most of MSM. If we look at the capital goods component, this is core capital goods here on the next chart. Minus 20 basis points sequentially, but also accelerating on a year-over-year basis to plus 5%. Again, best core capital goods growth number we've seen in 33 months. If you look at expected capital goods orders or expected CapEx, we don't have that chart here. Keith mentioned it in the early look. But what the Fed regional surveys, the asking one of the sub-series questions is, what do you expect for CapEx over the next 6 months? And they chronicle those. We bring them in, compile them, and create a composite index off of them. And you can see it's just a moonshot off of what we saw during that 5 quarters of contraction from second quarter of 15 to the second quarter of 16. So at the least, you can expect the capital goods numbers to remain solid near term. It's partly a comp effect. If we roll to the next slide, you can see a partial snapshot here of our table. So if you remember, durable goods, about 13%, 14% of household consumption, around 10% of total GDP, and you can see the headline there. So if we just roll forward to June, it's shaded green. You can see an easy comp there in June. So it was down almost 5% sequentially, down almost 10% year over year on the headline number. So even if we're flat sequentially versus May, you're going to have a solid headline number. A lot of the volatility comes in this non-defense aircraft and parts series. So you can see that highlighted in the yellow box there. So it jumps around pretty big. Orders are chunky and can be seasonal. So it's not, you can see just over the last 12 months where orders were up 150% month over month, down 60% year over year. That kind of volatility ends up showing in the headline and kind of swinging the headline. And then if we look down below that, you can see this sub-series ex defense and aircraft. That's your household demand proxy. A little bit smoother. They don't provide this. You have to calculate it yourself. But again, if you look at the June numbers, again, an easy comp. So you're not going to see a big swoon in June when we get those numbers next month.